Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our last monthly market update of the year. We want to wish our clients and their families a very Merry Christmas and Happy New Year. This was a picture, again, wishing you a Merry Christmas from our team at our curbside tamale event, where we had over 100 clients attend. It was great seeing everyone there. Because of your generosity, over 1,500 pounds of food was donated to Restoring Hope Food Pantry. So thank you again for everybody that participated. Our team also participated in Wreaths Across America last Saturday, where we honored those that served, the family members specifically that were buried in Houston. We honored them with a wreath laying there with a number of other volunteers. We look forward to seeing many of you at our January quarterly investment forum. You'll get this invitation very soon, so we look forward to seeing you there. So a lot going on this year. It's been a wild year. We'll kind of recap some of the things that kind of drove this year and what we're looking for into next. So it's been kind of a wild ride from Jan 1 to 4/8, and then from 4/9 on, the opposite, which is more to the upside. Some data that supports that talks about from Jan 1 to April 8th, markets were down 15%. And then from April on through the end of the third quarter, up 22%. And as we approach the end of the year, the markets sit about where they sat at the end of October. Not a lot of movement in the market in November and December. So a lot going on. We'll go to kind of the freshest data that we received just Friday morning before Christmas, which is the University of Michigan Consumer Sentiment revised lower to 52.9 in December from 53.3 on a preliminary. So one of the things we follow is consistently how clients are feeling versus kind of what does the data show. And this is an area that's showing some signs of weakness. And this just kind of points to that number again, that sentiment is low today. Part of that sentiment, expresses a dividing political divide in our country that talks about the difference in confidence from October of Republicans versus Democrats, and the 60-point spread is an all-time high. So we talk a lot about the Fed's dual mandate of price stability and maximum employment. We have fresh information on that from just this week. So inflation, most recently midweek, unexpectedly falls to 2.7. So we've got a sub-3 reading, still not at the Fed's 2% target, but definitely heading in the right direction. This surprised the market. So markets were expecting closer to 3 or a little above. And we got 2.7, which again were above or below expectations, which were for higher. We also saw kind of jobs added in November up, lost in October down. The official rate in October wasn't published. First time that's happened in 80 years. So I would say overall kind of a soft job markets, but picked up in November compared to October. So as it relates to the Fed, let's kind of go through the decision making that they've been through going back a few years. So we went through a radical raising process in 22 and 23 based on inflation that spiked. Then starting in 2024, so September of that year, we got a 50 basis point cuts and then 225s in 24. And then as we moved into 2025, we got 3 rate cuts, one in September, one in October, and then most recently in September. And with the Fed's commentary, they kind of signaled a pause in January. It's important to note that the Fed's target rate today sits at 3.5 to 3.75. And we're working towards what is the Fed's terminal rate, which is the rate at which they will pause. That is likely to include a couple of more rate cuts sometime during next year as we get closer to the Fed's terminal rate in the 3% range. As it relates to GDP, most recent GDP was up. The estimates are at 3.5%. So broadly, the economy being in growth mode, it has continued. And as it relates to the bull markets, we're currently, since October of 22, we're in the 38th month of a bull market that's up 91.5%, again, since October 22. Just going back historically as it relates to the average bull market, both how much the markets are up and how long. If this follows what the average is, we're looking at kind of a halfway through, both in time and momentum, the current bull market. So back to kind of a theme that we've talked about a lot, which is the top-heavy market. You'll see the top 10 companies measured by the S&P 500 are over 19 trillion today compared to 40 years ago at 250 billion. You have seen, by the way, as it relates to kind of the top-heavy market in the Mag 7, you'll see that over the last few years, all seven outperformed the S&P in 23, six of the seven in 24. But year to date, through the end of November, only two of the Mag 7 are outperforming the S&P 500. So you're seeing some widening out of returns, although, again, the market does still remain very top-heavy. And as it relates to AI and the tech bubble that burst, we've talked about this data point before, but as we got into the tech bubble environment, you had an 80% earnings growth and an almost 7x earnings growth compared to that. So this was a distortion of kind of stock price related to earnings. In this cycle, which we're talking about 4 years now, late 21 through third quarter of 2025, you'll see that earnings growth and stock returns are closer to a match. So what this says is that the stock price appreciation is more supported by earnings than if we look at a tech bubble where that was a 6 to 7x difference. AI is obviously something that the S&P 500 companies are talking about. 62% of them have some mention of AI in their most recent earnings call. We also have a kind of a top-heavy U.S. versus the rest of the world. Over the last 40 years, the U.S.'s share of global market cap is now roughly 2/3. In fact, the top seven companies now are over 20 trillion, just under 21 trillion of market cap, which makes these seven companies that are above 20 trillion or about 35% of the S&P more than the combined GDPs of all of these countries. So again, you kind of have a top-heavy market within the US and also in the US compared to the rest of the world. So as we kind of round out 2025 and head into 2026, we're always dealing with a combination of tailwinds, things that are supportive of the market, and headwinds that are obstacles to the market. And one of the things we never know is what combination of both of these are factored in. We talked today about how sentiment was down, jobs have been weak, earnings growth has been good, GDP growth has been good, and that on a net basis has resulted in an up market this year. But to continue, there has to be new catalysts on the tailwind side that are not offset by headwinds going into 2026. And I thought an interesting way of framing this headwind tailwind issue, JP Morgan's describing 2026 as an AI lift and economic drift. It's kind of their way of framing tailwind, more spending and more productivity driven by AI, but economic drift driven by things like inflation and labor constraints, et cetera. So just one way of thinking the headwinds and tailwinds that face us as we go into 2026. We will be early next year rebalancing, and we'll be sending out trade notes that discuss what themes we think are attractive going into the new year. So with that in mind, please contact us if you have any questions at all. We're here to serve you. The very best part of our day is time spent serving you. We hope to see many of you at our January quarterly investment forum, where we will be discussing all of these items in more detail. And with that in mind, we want to wish you a Merry Christmas, Happy Hanukkah, and the happiest of New Years. Again, from our team to yours, we want to wish you a happy holidays. Thank you for the opportunity to serve you. Again, the very best part of our day is time spent directly serving you. Until we see you again, hopefully at our forum in January, be well and take care.